We bought our first duplex after looking for 18 months for the absolute perfect deal. And I 100% agree, that's way too long. You should never take that long, but we did. Once we bought it, we moved in, and it was like the next day, the tenants on the other side of the duplex gave us a 30-day notice to move out. So what do? Well, naturally, you move into the garage. You don't move into that unit. Instead, you fix up the unit. And by the way, you do this in the middle of November, and I'm very thankful that my wife loves me. And then when 30 days were up, we moved over to the other side, lived in the non-fixed up side, and rented out the fixed up side. And we did all of that before receiving a single payment for rent. It's a little crazy, I'll admit, but that is what's called active investing, and that's just the beginning of the wild ride. But it's not for everybody. Instead, you may consider doing passive investing. I'm James Furlo, providing strategies and tools for real estate investors to maximize their long-term cash flow while minimizing headaches. Thanks for watching. I'm going to show you 7 ways that you can invest passively so that you don't have to give up your daytime job, spend less time with your family, but you can still make some really good returns by investing in real estate. But first, I got to tell you a little dirty secret about the real estate investing world on the active side that most people don't know. And here's the secret. Most of us are broke. We don't actually have any cash on us. I know it's kind of crazy to think about, but when you go to real estate meetings and you talk to most investors, almost every single one of them says, I need more capital in order to keep buying real estate. And even for myself, even though we were able to get out of my job in 12 years, we did that by buying 6 properties. And so that means that most of the time, I didn't have enough money to buy anything. I was just waiting around working my job while saving. And that is where the opportunity lies. If some people have the heart and the hustle, but not the money, and if you have the money, then you have an opportunity to invest passively. So there's 7 ways in which you can do it. Let's dive into each of them. The first one is a REIT. That's a real estate investment trust. And it works almost exactly like the stock market. You go to whatever stock trading app you have, and you can look up different REITs, and you can buy a share of that company. Now, technically, you're not actually owning real estate. You're owning the company that owns real estate. But part of what makes a REIT is that it invests almost solely in real estate and pays out 90% of its earnings to the investors. So it's as good as investing in real estate. The second one is equity crowdfunding. And so that's again where you're going to go to a website and you can get started for as little as $10 and you are buying real estate. Now the difference between crowdfunding and a REIT is that the REIT is the entity that actually owns the property and you own a stock of it. Whereas with crowdfunding, they're more of an intermediary. And what they're doing is they're connecting you with the other properties. Now, depending on which one that you get into, some of them you will get to say, I want to buy this property, and this property. Other ones, you give them more of an investment strategy. And so you buy a portfolio of different types of properties. So you're not buying directly, it's the app that is doing it for you. But the idea is you can get in for very small amounts, own a fractional share of a property, and get the rewards for it. And it works pretty well. The third way is buying what's called a turnkey rental. And so the idea behind it is that someone else has already bought it, already fixed it up, already got management in place, already got a tenant in place, and now they're selling it to you. And so when you buy it, you've already got a tenant, you've already got management, you've already got all the repairs taken care of. Now you just get to own it. Now, usually the company that did all the repairs and fixes also owns the management company, and that's also how they make their money off of it. It's a very good strategy if, again, you don't have the time and you're just looking for something that is ready to go. Perhaps one of the downsides of it is, A, you're kind of locked into a single property, so you don't get to take advantage of multiple different types. But then B, the second problem is that all of the value that could have been added to it has already been done. And so now you're investing purely for the cash flow. So you just want to make sure you do the math that the amount of money that you're going to put in for a down payment and the cash flow you're going to get from it makes sense for what your investment goals are. The next 2 are kind of related. So number 4 is to become a private lender. So this is like when an investor normally goes to a bank to get a loan. Instead of going to a traditional bank, they go to you and you give them a loan and you get some sort of fixed interest for that property. Now, typically these loans are 1 to 2 years because the investor's going in and fixing it up, making it better, and then they're going to refinance or sell it. And typically these are for properties that don't qualify for traditional lending. There's some sort of problem with it. Now, if you're going to do this, the trick is to get in with an active investor who knows what they're doing. And so don't get with someone who's saying, I'm thinking about getting into real estate and doing this. Instead, go with someone who's actually done this like 3 to 2 dozen times and has a proven track record. So that's what you're going to ask. Have you done this before? How did it turn out? Give me your metrics, and that'll kind of help you decide if you want to lend on them. And your rates are going to be somewhere around what a bank will get. It could be a little higher, it could be a little lower. It kind of depends on what you're able to negotiate. It's still passive in the sense that you're not doing the active investing, but clearly there's some activity there where you need to network, get to know someone, and check up on the deal. But it could be a great way to supplement your portfolio. Number 5 is yet another private loan provider, but this time it's working with a hard money lender. So when I was describing the first type where you actually network with investors and you look at their track record and you try to decide, is this a good property? Do I think they'll be able to pay the loan back? And you're going through all the paperwork and looking into it. Yes, it's passive, but it takes some work. Instead, what you do is you partner with what they call, again, a hard money lender. Now, what they do is they've got an office of people who network with investors, who vet out deals, who know the marketplace, who will negotiate the interest rate and all the terms for the deal for you. And then oftentimes you're not the only one who's giving money. There's a whole group of people who are providing the loan to this investor. Now, the way the hard money lender makes money is by charging points on the loan, essentially fees. And so they make their money off the fees, you make your money off the interest, and part of the service that they provide to you is finding the deals and making sure that they're good ones. That could be a great option for you to get in. And the other nice part about it is that you can do fractional loans, where normally if you're going one-on-one, you need to provide the entire loan for the investor. Whereas with this one, you can go in with a dozen other people who you may never meet and never know and provide that loan. So that's an interesting option to become a passive investor. Okay, these next 2 are probably my favorite, and this is where you become a limited partner. It's very similar to the REIT and the crowdfunding, but on a much bigger, potentially more creative level. So number 6 is to get into a joint venture. So that's where you've got one person who's the active person, and you've got another person who is the money provider or the limited partner. And they come together and they say, I'm going to find the deal, I'm going to manage it, I'm going to make sure everything works. And this guy says, I'm going to provide you the cash to do it. Go do it. Again, these are usually for properties that don't qualify for traditional lending. But here's what's interesting. You both are owners. So if you wanted to get a loan, if you were able to qualify for a loan, you could. So for example, maybe you buy a property that's just in shambles and you don't say, I'll give you a loan. Instead, you say, I'm going to get in on the profits with you. So you provide the cash, which could be a lot depending on where you live. You buy it, you fix it up, and then you rent it out. And then instead of selling, what you do is you refinance it and you get a whole new loan on it. You as the private investor get, ideally, all of your money back or a large majority of it back. And now you own this property together where you're getting the cash flow and it's got a loan, so it's leveraged. Now, some things to think about with that is you really got to make sure that you trust the person who you are investing with, because it's just going to be you and them who are doing it. And it can work really great. It could be a great partnership. You could roll on to a lot of deals and just slowly start building up that cash flow over time. But you really got to trust that person who you're going with, because if they're unscrupulous, there's not a lot of eyeballs who are watching over them. And then finally, number 7. And these are syndications. And this is what my company does, so we're aware of them. And a syndication is where a group of people pull their money together in order to buy real estate that is really expensive or bigger and would just be out of reach for everyday normal people. So it's similar to a joint venture in the sense that you have an operator, someone who is buying it, the active person. And then instead of it being a one-on-one thing, you have multiple people who are going in on this. So instead of doing a single family home, you are doing a 50 or 100 or even a 600 unit apartment building. And what's cool about it is you are all owners for it. And so you're still getting a loan and all the benefits to that. You're still getting the cash flow, all the benefits of that. You're still getting all the tax benefits. You're still getting the benefits of rents going up, even in inflationary times. There's so many benefits. And because you are a limited partner, you don't have the liability associated with the loan or other potential downsides. And so it's a super cool way of getting in on some bigger properties. Now, I like syndications for a lot of reasons. Number one, the property's bigger, and so it's a bigger pie. And what that allows you to do is hire people to help you do everything. So for example, you can hire an expert property manager who does that. That's what they focus on. That's their job. They know and they like and enjoy it. That's a huge benefit for me, to have someone who I trust in there managing the property. The other really nice part about it, and I'll admit as a former data scientist, I really like this, is that it's more predictable. Whereas if you have a single family home and the water heater goes out, well, that might be your cash flow for the next couple of months. Whereas on a bigger property, if a water heater goes out, depending on the size, even like a 50 unit place, you go, it's not that big of a deal. And you can plan for these things going out, and you can save for them because of the economies of scale. Those often work out really, really well. Now, the one downside of that one is that unlike the loans and some of the other things, you are committed to this investment for 5 to maybe 10 years, depending on how it works. Now, ideally, what happens is you find a property that, say, it's older, right? It's from the 70s, it's kind of outdated, it needs some updates. And so you, with this pool of investors, go in on this syndication, you buy it, you fix it up by rehabbing the units, bringing it up to date, and you do that slowly over time, and you increase the rents as you do it. And then eventually, maybe at the 3 to 4 year mark, what you do is you refinance. And ideally, you're able to pull out a majority of that cash so that you can go off and invest again or do whatever you need to do with the funds. And then you still own this property, you're still getting the cash flow, and then maybe 10 years down the line, you're ultimately going to sell it again and get the remainder part of that capital out. There's so many options with it. It's really cool. The other nice part about it is because it's bigger and there's so many people involved, the SEC does actually pay attention and does care, and so it tends to make everything on the up and up with all the legal documents and disclosures just to make sure you really know what you're getting yourself into. That's not necessarily the case with joint ventures at all, and could not be the case with the loans either, though hopefully you can get the right people to help you do it. So there you have it, the 7 different ways that you can passively invest in real estate, ranging from as simple as downloading an app and spending $10 on a share of a stock, all the way to getting involved in a syndication where you are helping to buy a larger property and enjoying all the benefits that come with it. If doing a syndication is of interest to you, that's what my company does, and I'd love to chat. You can visit our website, learn a little bit more about us, and then set up a 30-minute phone call where we go over your goals and your priorities and see if you're a fit to invest with us. If you found this video helpful, please like it. And if you'd like to get more strategies and tools to maximize your long-term cash flow while minimizing headaches, please subscribe. Thanks for watching.